Hello everyone. In this tutorial, we'll be learning about risk preferences. So to motivate the material, I would like to begin with a practical example. So let's suppose you have saved $10,000 and you would like to invest this money. And suppose you've been attracted by two competing offers from two different banks. Okay, so you will deposit the money with these banks, let's say over the course of a year. So let's suppose the first bank, let's call it Bank A, offers a rate of 10% on the deposits, right? So this means that if you invest your money now, at the end of the year, you will definitely earn a 10% return, meaning that you will end up in total with $11,000. Okay. And we have another bank, Bank B. And let's suppose these guys offer a higher interest rate on the deposits. Okay. So let's say they offer 20%. Then you might say, okay, this is no brainer. Definitely I go for Bank B, but there's a catch, right? So there is a small chance that this bank may go bankrupt, right? So it might default, basically. So let's say with 90% probability, this won't happen, and you will get your return, so 0.90 probability. But with 10% probability, right, the bank will default, and you will only recover an amount that is insured by the government. So governments typically offer deposit insurances to support the banking system. So let's say in this scenario, you would only be getting back $2,000 back. Okay, $2,000 back. This essentially means a minus 8% return, right? So you lose 8% of your capital. So let's suppose Bank A is totally safe. So with 100% probability, you get this 10% return. So there's no default risk here. But Bank B is a little bit risky, but most of the time you'll get 20%, in which case in total you will get back 12,000. But if the worst happens, you will lose most of your money. Now, here's the question. Which of these two banks do you prefer? Would you deposit your money with Bank A, which offers a certain rate of return of 10%, right? Or would you go with Bank B, which offers a much higher return, double the amount, but if it defaults, you lose most of your capital, right? Think about it for a second. You can pause it and try to make up your mind. And also bear in mind that there's no right or wrong answer here. Okay, so it's not that one offer is better than the other as such. So it's not that one offer is dominating the other. It's really about your risk preferences. Okay. And to make it a bit clearer, let's actually calculate the expected return for Bank B. Okay. So if you put your money into Bank B with 90% probability, you get 20%. Plus, with 10% probability, you get minus 8%. So this is 18%. Okay. And this is minus 8%. So if you add them up, this is also 10%. So Bank B, like Bank A, is offering 10%, but the key difference is that this is an expected return, whereas there is no risk here, right? So this is a safe return of 10%, right? So now the choice is really between, do you prefer a certain, a risk-free 10% return, or do you prefer an expected return of 10%? And your answer basically determines your risk attitude, okay? So in general, in economics and finance, we focus on three distinct types of risk attitude. We talk about risk-averse behavior, So this is the first category. We talk about risk neutral behavior. And we also talk about risk-seeking behavior. So, for example, if you always exhibit risk-averse behavior, you are essentially a risk-averse individual. Or maybe you are always exhibiting risk-seeking behavior, in which case then we would call you a risk-seeking individual. Now, how do we associate these three categories with the example that we have just seen, right? So to summarize that example, Bank A was offering a safe 10% return, whereas Bank B offers an expected rate of return of 10%. Okay, so there is some risk involved in the case of Bank B. So for each category of these three types, what would be the choice? Okay, so basically, risk-averse individuals would prefer A over B, right? Because from their point of view, they see that, well, essentially these two figures are the same, right? Why should I bear risk? I don't like risk, I'm risk-averse. So I would go for A and get the certain 10% return. A risk-neutral person would say that, well, they're both 10% and I'm neutral towards risk. So I am actually indifferent between these two options. And as you can guess, risk-seeking people would say, well, I quite like that 20% return possibility. Remember, with this one, you had 90% probability of getting 20% and 10% probability of losing 8%. For the risk-seeking person, well, it's still the same amount, 10%, 10%, and here I have the potential to get 20%. So I do actually, oops, sorry, what happened here? I do actually prefer B over A, right? So these are risk lovers, essentially. So as long as in expectation you don't get less, so these guys will go for Bank B, okay? So this is how we classify risk preferences in economics and finance. And I should tell you this as well. So many of us might exhibit different types of behavior or attitudes towards risk in different circumstances. So there are well-established finance theories which would basically argue that in certain circumstances we would be risk-averse, but there might be also scenarios where we could be acting in a risk-seeking manner. Okay, so the general assumption in most economics and finance models, the neoclassical models, is that in general we don't like risk and we are risk-averse. But if that was strictly true, then no one would gamble, right? No one would go to casinos, or no one would be betting money in sports events, or engage in any sort of betting, because gambling and betting behavior is more consistent with a risk-seeking attitude. So clearly, many of us would time to time occasionally buy lottery tickets. Some people actually go gamble in a casino, risk money, and so on, and which means that many of us are actually not always risk averse, right? But the more traditional models would assume risk aversion in general, but also finance acknowledges that people can behave risk averse under certain circumstances and risk seeking in other circumstances. Okay, and to make that clearer, I would like to show you the link between risk preferences and the shape of a utility function. So we would look at basically amount of wealth we have and the utility we derive from it. Okay, so this is again a classical topic in finance. Basically, risk-averse individuals have a concave utility function. Okay, so this is sort of the shape that would mathematically result in the individual choosing bank A, the safe one, over bank B. Okay, so mathematically you can show that risk-averse people, if they have this particular utility shape, it is more beneficial, so it would maximize their utility, expected utility, to choose A over B. Risk-neutral people would have what we call a linear utility of wealth. Okay, so their utility function will be linear because they only care about the expected value of different opportunities, sometimes called gambles or lotteries or prospects. So they would have a linear utility function, and this sort of function would result in behavior where they are indifferent between A and B. And finally, sorry, I'm just got a pop-up window, apologies. And finally, we can have risk-seeking people with what we call a convex utility function, right? Risk-seeking people having a convex utility function. So for these guys, they actually prefer B over A. So we have a convex shape here, linear shape in the middle, and a concave shape on the left. Now, like I said, in general, we don't like risk. So in many circumstances, we would exhibit risk-averse behavior, which would imply a concave utility function. But prospect theory, for example, assumes a utility function that looks like this, and actually this implies risk aversion in gains, okay, and risk-seeking behavior in the case of losses. So prospect theory focuses on what's called a reference point. So it focuses on changes in wealth rather than the level of wealth, and argues that in certain scenarios where we are faced with gains, we are risk averse, but when we are faced with losses, we can actually be risk-seeking. Okay. But coming back to this idea of risk aversion and not liking risk, it leads us to another important concept, which is called the risk premium. So this is really the backbone of financial markets and how we price risky securities such as stocks, corporate bonds, derivatives, and everything. Okay, and the idea is very, very simple. So think about a risk-free asset that would yield a risk-free rate of return. Let's say it is 2%. Okay. Now, let's suppose there is a risky stock and it will yield an expected return. Now, from the risk-averse investor's perspective, this has to be higher than 2%. Because if there's 2%, the risk-averse guy has no incentive to buy the stock, because he will think that, okay, if it is 2%, I don't like risk. I can just invest in the risk-free option. So this is like putting money in the bank. So for example, if this was bank A, the risk-free rate of return is 10%, whereas bank B also offered 10%. So this wasn't good enough for the risk-averse investor. So for the risk-averse investor, for the risky option to become more attractive, it has to offer something more. And that's what we call the risk premium. So it is essentially a reward for bearing risk. So risk-averse individuals demand risk premium to invest in risky securities. For example, if bank B was offering 12%, this would imply a 2% premium. Then the risk-averse individual will think, okay, do I still prefer A, 10%, or do I now switch to B, which is 12%? And that would depend on the degree of that person's risk aversion. If that guy is particularly risk averse, this may not be a sufficient risk premium. So you might say, this is still too little. I would switch to B only if I get at least 4% premium. So that's the point for me to switch to B, right? So this will differ from one person to another. And in general, the riskier the asset, the higher the premium it should offer to entice risk-averse investors. So, for example, risky stocks should offer higher risk premiums than safer stocks. Okay. Later, we will learn that this risk premium will depend on what we call the CAPM beta, right? The stock betas and how which captures the sensitivity of stocks to general market movements. So stocks with higher betas are considered to be more risky, so they should offer higher returns to their investors. Now, here's a bit of homework for you guys. So we got a couple of true or false questions here. You can find a link to the answers in the video description. And that's all I wanted to cover in today's video. Thank you for watching, and I'll see you guys in the next lesson. Bye for today.